Good morning, ladies and gentlemen. This is Clueless 8. This is a pre-market AM report for December 15th, 2015. Weeks ago, I predicted and forecasted that give or take a couple of days, 2-3 days, whatever, around the middle of the month, we hit some major turbulence. It was no different this time. If you calculate the time period from when the sell-off began, and now the short-term retracement bounce. The key word is short-term retracement bounce because we have no idea what the exact reaction to the Fed rate hike is going to be. We can sit here on a fundamental basis and debate all day long whether or not it's a good thing that the Fed is raising rates. I have promoted my thoughts or explained my thoughts on the process. I think long-term it's a very favorable move. But on the short-term basis, I believe that we're going to hit another wave of turbulence, which is going to kick off tomorrow. The markets are not linear. The markets are not a linear process. They're not a binary process. 1 + 1 does not equal 2. Like to deviate for a quick second and address a lot of new members and free trial subscribers who have some of who have joined, some of who are currently visiting. My service is designed for you to maximize your potential and your trade skills with the use and the benefit of my charts. You're not here to mimic every single trade that I do. Keep in mind that my trading book incurs far higher gains and profits and far higher losses. So my volatility or beta factor in the book is far higher than a lot of people out there. Everyone has their own personality. That's what is a major component, what I call behavioral game theory, in their own trading methods. I have some very specific guidelines that I follow based on my years of experience on studying and understanding pattern symmetry, why markets do what they do, the fundamental, technical, and emotional, what I call behavioral game theory reasons why things happen. And in most cases, in I would say majority of instances, I have been correct. However, the timing can be uncertain due to the heavy involvement of algorithmic high-frequency trading programs within the market that cause these type of very large pullbacks and sharp moves higher, sharp rallies, what I call retracement bounces. The overall picture in the market still remains, the primary trend on the market is still higher. The bull market is still very much intact. However, what will happen months from now, or what will happen or even sometimes over the short term, is an unknown. So what I try to do to my best of my abilities, and all my loyal followers and people who have known me for years, and since I started my service on April 15th of 2014, that I will put out some very precision tactical charts out there, trade alerts on individual stocks, on the indices, and give a macro global economic explanation as to why I think things are happening the way they're happening and what my thoughts are going forward. But it is completely up to you, because to manage your trades and to maximize the power of the content that I'm producing. It's really as simple as that. I repeat, do not try to mimic every one of my trades, because my book is larger, my trading book is larger, and at the same time, I incur, like I said, larger losses at times that I take advantage of, manage it well, and then produce very powerful gains or profits. This morning is another prime example. Yesterday was also a very good day. Now, in between, I'm both long and short, and people might wonder, like, why I'm changing direction in the middle of the day. Keep in mind, just because I'm having hedges, that I keep hedges in the form of the UVXY, the S&P puts, SPY puts, or IWM, or whatever the case may be, puts and on the short side, or short an individual stock at certain times, does not mean that the bulk of my trading book is biased towards that particular corner. Very seldom have I gone completely short, and when I have done that, in some cases, I have taken those profits rather quickly, because the danger with this market is, and I think all of you realize, and look at yourselves in the mirror too, that the volatility, the structured volatility that has been introduced in the market and will remain so for years to come, is designed to confuse, to scare, and to completely obliterate rational thinking by investors and traders. For that reason alone, some of the finest minds in the business have, in this case, many hedge funds, for example, brilliant minds have shut down shop and returned the money to their investors. Saying all that, let's dive directly into the technical aspects of the market. And again, I am being validated and vindicated for my work on what I said was going to happen weeks earlier, if not just in the past couple of days. It is extremely important, especially for the newer members, to review every single one of my charts, listen to every one of the video casts that I produce, because all of them, once you connect the dots, you'll see the sequence of accuracy and my credibility. Saying all that, I reserve the right to be wrong. After all, it's the market. I don't control it. Asking me direct questions on what the market will do on a very specific moment, I can only answer based on my predictive precision charts and many different platforms that I use, as you all know, but I cannot tell you exactly what will happen at any given time other than forecast my the movements. Saying all that, trading and investing is a game of probabilities. It is not a game of certainties. And I repeat, the point of maximum pain, even on a technical level, can be seen on a technical level in the markets at many different inflection points, including all these different points where people basically gave up. Fear is not a trading strategy. In my opinion, one must have a bias on which way they think the market will end up by the end of the year, looking at it short term, and then act accordingly. Are dips, technical dips I should say, meant to be bought, or are you going to hide in the bunkers and stay away and wait for the quote-unquote perfect moment that, with full blast sarcasm, like I say, never arrives? There are no perfect moments in life. Life, as in trading, is a process. Act accordingly. Chart of the E-minis here on the futures, on the S&P 500. As I clearly showed before, and I'm showing again, you're starting to see the deep oversold conditions on the stochastics, on the McClellan oscillator, down in the minus 300 level. At this point, well, close to 300. These are extreme oversold conditions. Or you can look at many different charts. You can look at the NYMO, the New York Stock Exchange, and the Nasdaq McClellan oscillator. You can look at the TRIN. You can look at many different factors. You can look at the general feeling when you turn on the TV and you listen to CNBC and Bloomberg. There is nothing but doom and gloom. Generally speaking, those are short-term tradable bottoms, manifested in the form of technical charts that I'm showing in front of you. At this point in time, 1982 in the E-minis should act as major support. On the upside, right as we speak on real time, we're engaging this yellow line here, which is the 5-day moving average, and we're going to hit a little bit of resistance at this point. Above the 5-day moving average, we need to cross over 2031 or 2034. And at that point, engagement on the underbelly of this rising, and I underline the word rising, 50-day moving average at 2056 on the E-minis could be a strong possibility. I believe the market at this stage has two scenarios, obviously. And I did a very powerful video cast, which you can find on the Clueless 8 channel, which clearly shows that, which was the bull and bear scenario on the Fed hike. So let me get my drawing tool here and show you. On the bullish front, which I predicted weeks ago, this would be a dragon bullish formation. Okay, and we get up to that 2100 level again, where we encounter heavy resistance. The uber bulls would say, and I'm certainly not an uber bull, I am generally optimistic, but a tactical bull and a tactical bear at times, that if we break out over these levels, then obviously the upper Bollinger at 2138 and the previous highs are going to be eclipsed. So at this point, it could be a dragon bullish W formation. And like I said, nothing is linear. This lows were breached yesterday. We slipped down, scared the living daylights out of people, and then at around 11 a.m., huge massive turn. And if you look back at my charts that I posted, you can clearly see intraday what had happened. And we certainly took advantage of that. Now hedges, keep in mind the UVXY and the SPX puts are are hedges. So you cannot, in my opinion, go out there and put the bulk of your trading monies into one side or another, because look what happened at the end of the day. It was reported later that there were 11,000 to 20,000 S&P contracts bought for expiration this Friday. Okay? Right in the money, which would be around the 204 level or the 2020 level. On the SPY's, the 204 level. So whoever bought that, that's a big sum of money, is expecting a sharp move up into quad witching, which comes up this Friday. This is monthly options expiration plus it's quadruple witching, which generally has a bullish bias. It does not mean that we're not going to see a massive 200-300 point move at around the time the Fed announces and the press conference, and then pick up the pieces and run from there. So that's basically what I'm looking at. So at this point in time, we have so that's one scenario. The second scenario, which I've explained in clearest terms, is that we fail in this zone and we fall rather quickly into this. There is a minor gap here that you see on the S&P 500. I've shown my charts at around the 1950 level. That is also a possibility. If we break the 1950, 1960 on the S&P, let's say, we are going to rapidly fall into this no man's land right here, down here into the 1800s. Okay? Because that's just the way technicals work. That's the way algos work, and the panic that ensues after that, stops are triggered, and things move fast and furious. So at this point in time, looking at what we have in front of us, the 1975 level should be the 1980 level on the E-minis should hold as support. Internals are suggesting, again, it's not linear, but internals are suggesting a sharp bounce, which could carry us up towards a 2080 level on the E-minis. Let me quickly go over the S&P 500. Now keep in mind, all the trades that you do are held hostage to what's happening on the forefront, and that's in the indices. And that's the reason why I focus a lot on the S&Ps and the Russell 2000, the NASDAQ 100s and such, to give you a directional bias as to what might happen. I have 2 minutes left for this video cast. So here we have a downtrend line, not magic, that this downtrend line was drawn weeks ago. Actually, it was drawn on the 16th of November, and we have a reversal candle directly off that line. Magic, right? So at this point, I am looking at the first level of resistance at around the 2037 on the E-minis, which we might get today. I'm seeing Apple down, so that's going to pressure the markets a bit. And calls that we bought at the lows yesterday that we kept on accumulating, the S&P calls, are going to be sold. In my opinion, a bunch of it should be sold at the open, and then we see what happens. So at this point in time, playing around with the technical lines here, given the fact that this was the support level, I'm looking at around 2044 as a max move. If we do cross over sharply over the yellow line, which would be the 2039 S&P line, then we should expect to see a move up towards 2058. That's it for now. Listen to all my work, follow my charts, and benefit from the Clueless 8 trading service. Thank you for listening, and all free trial members are encouraged to join and become part of the service. Have a great day.